Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 9th of June 2022. Later, savings rates, they are on the way up. But first, the Australian share market, which did fall to a one-month low today, the 200 down 1.4% to 7,019. That follows a very poor performance from the banking sector. Bank stocks have been falling ever since the Reserve Bank lifted official interest rates more than expected on Tuesday. And since Tuesday, one of the worst, for example, was Westpac shares in that company down by 11%. So for more on the banks and the rest of the broader market, I spoke earlier with Angus Geddes. He's the CEO of Fat Profits.
Look, I think the main reason the market's down is that we've seen a lot of selling in the banks. And, clearly investors are very worried about rising interest rates and the follow-on impact that's going to have on banks' underlying profitability. Will bank bad debts, doubtful debts, will that rise as interest rates rise and defaults pick up? So that's the concern.
At the same time, though, aren't higher interest rates good for the banks?
Well, they are. They certainly are in terms of their net interest operating margins, which will expand. But I guess at the moment, the market's looking sort of 12 months down the road at a much higher cash rate, possibly, well into the twos, towards 2.5%. And, in terms of what the knock-on impact that will be.
So the banks are being slammed. They've been hit ever since the RBA lifted rates more than expected on Tuesday. Fundamentally, though, are they still good? Has the recent sell-off been overdone? Is it an opportunity?
Look, I think the selling probably has been a bit overdone. I guess the first point is that Australians tend to hang on to their house at all costs. They'll cut back on other discretionary items before they stop paying their mortgages. So, perhaps, in that respect, pricing in a lot of bad and doubtful debts might be well and truly overdone. The second point is that with rising interest rates, bank margins are going to expand. Yes, we might see a cooling in the housing market. We might see loan demand come off the boil, but, we're a long way away from, having a property market crash. So I think, all things being equal, it is perhaps a bit overdone.
So apart from the banks, where are investors switching away from and to?
Look, the biggest switch that's going on in the market at the moment, by far and away, is their rotation into resources which are not leveraged to the Australian economy. Their earnings are derived from commodity prices. Commodity prices are having a very good time at the moment, and that's where a lot of the capital is rotating into.
Angus Geddes there from Fat Profits. Now, savers are finally being rewarded after years of next to no interest on their savings accounts. Today, an interesting release from Macquarie Bank. It said it will be increasing the interest rate on its transaction savings accounts to match its high interest savings account. So that's a pretty significant move. So will this start a deposit war? For more, Massilia Aili spoke with Finder's Sarah Megginson.
A higher cash rate is bad news for mortgage holders, but it's actually really good news for savers as rates increase across their savings accounts. It's quite normal for banks to increase the rates on savings and term deposits, but it's quite unusual for them to increase it on a transaction account. This is your everyday spending account. So Macquarie's actually introduced an offer of 1.5% on your everyday account, which is really quite unusual, and it's available on balances for up to $250,000. So I think that's going to be some really welcome news for people, who haven't had a big return on their savings the last couple of years.
And are there any other institutions with such high rates as well?
Yeah, I mean, it's actually starting to be quite a competitive time for savings accounts. After a couple of years of not much happening in this space and really low returns, we're starting to see more and more banks and lenders come out with some really competitive offers. So no one is actually doing, or no one that we can see is actually doing anything on transaction accounts the way Macquarie is. But there's a lot of competition in savings accounts and term deposits. So a couple of the offers out there at the moment, there's the ING Savings Maximiser. ING are often quite competitive with the rate that they pay pay on savings. But as of the 15th of June, they're upping their game quite a lot. They're going to add a 0.75% increase to what they're offering, which brings it up to 2.1% per annum, which is one of the best rates in the market by far. But there's also quite a few other offers out there. Bank of Queensland has a future saver account for under 35s, which actually offers a 3% return, really, really strong. And Westpac Life has another under 30s account as well that offers 2%. And we've got Virgin Money Boost Saver at 1.6%. So there's definitely quite a lot of competition, and it's worth comparing to see how you can get the best value for money.
And why would it want to lift its rates to so high? Does it benefit the company as well?
Yeah, it does. It's a really good question. These banks and institutions, they lend money out and they can afford to give a little bit more of a premium on that now because they're charging a higher interest rate on the money that they lend out as well. So even though they're paying you 1.5 or 2% for your money, they're going to have quite a premium on that and charge it out at 3 or 3.5%, even more on that money when they lend it out. So there's still quite a good margin there for them to make a profit. But it also really benefits them to be competitive at the moment. It's hard to stand out, especially in the savings industry or kind of savings market. There hasn't been much competition in savings accounts for the last few years. So it's really exciting to see all these banks and lenders come to the party with all these different offers. And they're all trying to stand out a little bit and get your business. And, you know, this is kind of a customer retention or a customer grab play for them. You know, if they can encourage you to sign up with them on a savings account, they might then convert you into a credit card or a home loan, and then you become a much more valuable customer to them over the long term. So, you know, it definitely benefits them to dangle this carrot. And I think they're going to have quite a lot of success in, you know, getting people interested in these deals.
Massilia Aili there speaking with finder Sarah Megginson. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.